Hello guys, in this video we are going to cover advanced liquidity concepts. I am going to show you some examples and tell you how it works. The advanced liquidity concept usually works when you see equal highs or equal lows generated. In this case we have equal highs, and the reason that we use it is to know how the price act right when equal highs are formed, and the way up to the equal highs and the move away from the equal highs. So right away we can see this setup. This is a turtle soup setup, but in the meantime we are in a bullish trend. So that just means we are looking for longs, not shorts. So the first thing I want to cover is that in a bullish instance, if we see equal highs being run, we anticipate a retracement only to equilibrium price point, which is, let me draw it out. Like I said, the 50% of this range is right here, so this is the equilibrium price point. Anything below is discount price, anything above is premium, and we want to go long in a discount price. And like I said, we anticipate price going back only into a equilibrium price point and maybe go into a little bit of discount price. And also if it was a bearish instance and we were to create equal highs, we would absolutely anticipate price running these lows. Alright. So we would anticipate running these lows by price in a bearish instance. But the way we know it is that in a bullish trend, the longer term lows will not get broken. Right? So let's just look at this setup. So right away, when equal highs are generated, we anticipate a move away from it, preferably in a deep discount. You can see here it is, anything below is discount, and the way we do it is we look below the discount and find a objective, which in this case is a imbalance. This works the same. We look for a objective below equilibrium, which in this case is a order block, and that's where price will react off of. So let's look at this setup and how I would react to it in real time. So right away, when I would see equal highs generated, I would see a move away from it, preferably, and a move up for it for a stop run, and a retracement to equilibrium price point. So this setup is pretty great. We have a fair value gap and a liquidity grab. It is a perfect trade. Your take profit would be at this order block, your stop loss above the last high, which is this, take profit, this order block. Right. There is two trades that you can take when you see equal highs formed. You can take the trade which is the way up to the equal highs, or the move away from the equal highs when the stop rate happens. Okay, so that is your two setups when you see equal highs formed. I prefer the move away from the equal highs because because they're just more powerful. But of course, when you are in a bullish instance, you'd want to take longs, and I would have taken this one also, because as you can see, this is almost twice the take profit than on this trade, and that is just because we are in a bullish trend. We can look at this also. So this is also a turtle soup. We have a favorable gap, a equal lows, which in a bullish instance is ideal. We tap into this favorable gap. I would take a trade, a long with small lots, and when I see equal low generated and that being ran, I will go in there with the bigger lots. Your take profit would be the symmetrical swing high of this range, which is just measuring the size of this retracement, rejecting it above, and that is your take profit. This premium discount also works here. So you draw this out, you can see. As you can see, this is the 50%, this is equilibrium. Like I said, we anticipate a retracement only to the equilibrium price point. And the way that you're going to make that more precise is that you are going to look for a favorable gap at or below discount price. Okay, and in this case is this favorable gap. And as you can see, it works. One more thing that I want to note is that areas with higher amounts of consolidations, meaning more lower highs, higher lows in one area, means that area is high resistance. Okay, that just means that for price it is a lot harder to break through. It works kind of like resistance, like subordinate resistance, but we are not using it in the retail sense, but we are only using it to simplify the reason that it works like this. The reason it works is because smart money hedges their trades, meaning they take longs and short in a bullish trend and also in a bearish trend, and in order for them to unload their longs or shorts, they need to come back to these areas with up candles and down candles. Let's say that they have gone long right here. They will need to see a move back up to this PDRA. We will call this a order block. This is also the same. You can see it has a effect on price. It retraces a little bit. This also, they have gone short here, right here. So price comes back to below their shorts, so they exit in a profit. Right? Then it shoots up. So that's the reason areas with consolidations or quote unquote high resistance areas, they are harder to break through. Clean ranges just like this are a lot easier to break through as you can see, price just slides through it like straight butter, right? I'm going to show you this example backing up that idea. So this price, these bars are easy to break through. As you can see, price easily break through those price points here. But these consolidations, these, right, these, anywhere from the start of these consolidations, we anticipate price being high probability of reversing because it is a high resistance area, right? And as you can see, this line is the low of this lower high, which is also just smart money hedging that trades, and we can see price did have a effect, and it showed in the form of this retracement. Even if we go higher, we can see this order block, and we projected the low of it out, and that is also a point of hedging. It's also a high resistance area. Now these high resistance areas usually reside in the form of order blocks, mitigation blocks. We just use those terms like order blocks to make it more understandable. You can see the moment it tapped this order block, it reversed. The reason that it did not reverse at these order blocks is because we have a previous large consolidation, right? Which is this, and this order block is inside of that. So that's why it was so powerful. Typically, we would not want to be trading high resistance areas. We would not want to anticipate price running through those because it has a high probability of not happening. As you can see, this is also a high resistance area right here, and price could not break through it, right? But this range is very clean. Price just slides through it. So this video was just a overview of all of the concepts I taught on my channel yet, meaning liquidity traps, equal highs, equal lows, premium discount, fair value gaps, order blocks. We have just all combined it in one video, which forms a inner circle trader strategy, right? Which is this. I personally purely trade on based on liquidity and fair value gaps, which is the same thing. My favorite setup is turtle soup, alright, and the retracement, because I love to find this anything below the 50%, anything below it residing as a objective, like a order block or a fair value gap. That is your objective. That is where price will react off of. That is very easy to find. You can do it too, trust me. Right, so I want to mention one more thing about drawing out the Fibonacci retracement tool. I use it purely to find the equilibrium price point. Sometimes I use it to find the optimal trade entry prices, but that is pretty rare. You want to draw your fib on the bodies of the candles, not the wicks, because brokers can alter the differences of the wicks. They can change the spreads, and for different people it may be different, the wicks. So since we are on the 4-hour chart, I might just do a daily bias forecast for next week's trading. It is weekend right now, so I did my weekend daily bias analysis for next week's trading. And my idea of price movement is, since we failed to make a retracement higher than this last high, I am anticipating a short-term market structure shift, and we also failed to close above this swings high. So that is the reason that I am anticipating a retracement back down to this order block and fair value gap, this order block. And of course, I hope you noticed it. We have equal highs above, so that is our main target. Alright, so anticipate price coming back to this fair value gap and order block and running for these equal highs. It's not even equal highs. This is triple highs. It's a really high probability that it will run for these highs, alright? And we would want to see a deeper run, right? We would not want to see a sweep, but a run, okay? Around this size, right? And the moment that we run it, we will do whatever, right? But of course, this could change. We could retrace to this fair value gap, but anything below is pretty low probability that it will retrace down, because as you can see, like I thought, this is a high resistance area and we will not see price running that area. So my entry is of course at this order block. The way I did this is that I looked at the 50%, which is here. So it is, this fair value gap is at a equilibrium price point, which is also great. So my entry would be of course here at equilibrium. My stop loss would be just below this fair value gap, because like I said, anything below this fair value gap is pretty unlikely. And my take profit of course is at the equal highs. I think I should just make it bigger, because we are anticipating price running deeper into these equal highs, right? So this is my daily bias forecast for next week's trading. I hope it was insightful. Keep backtesting and see you in the next video. Peace.